Let's bring on Ryan Detrick and his colleague, Sonu Varghese. Let's get him on right now. Guys, how's it going?
Here we go.
Oh,
we make it?
All right. Wow. Oh, wow.
Yeah.
Look at those Bengals this year. Come on, Detrick.
Now,
what's going on, buddy?
You know I'm going to talk a little bit about the Dolphins here. So
How can you not?
Don't you worry about that. I mean,
talk about bull markets. You want to talk
thinking, though, JC, I mean, this is the sixth one of these you've done. Is that what it is? Sixth one?
Yeah, that's right. That's right.
So we're getting feedback, aren't we? So I have done, I think, 4 of these. So thank you so much for inviting me back, man.
Listen, best in the business, Ryan Detrick. You know, for you guys who don't know, Ryan and I go way back for sure.
Yeah.
One of the best technicians in the world, in my opinion. You've been doing a heck of a job for many years. A lot of people know who you are. No surprise here. Sonu, nice to meet you.
Yeah, I want to bring Sonu on. So, Sonu, I work with Sonu at Carson Group. He's amazing. He's not a pure technician, but here's what he is. He's an engineer. He's not a CFA. He manages a lot of money, and he understands trends do work. So I said, Sonu, you got to come on and do a little bit. So we're going to, Jason, you know I brought a lot of slides, so we probably need to get rolling, man. You ready to start?
Did you bring any charts? Any spreadsheets, maybe?
I mean, is the screen sharing? Do you see it? Is it working?
Oh, I see it.
Okay,
I see it, buddy.
You know,
go get them.
You gave me like 30 minutes. I got like 30 charts and slides. You know how this.
Listen, everybody out there, Ryan Detrick's going to do a hell of a job. Tell your friends, tell your family, tell your colleagues, anybody who's interested in making money that you know, send them a link, chartsummit.com. Tell them to get their butt over here right away and listen to Detrick. All right, guys, go get them.
All right. Well, I do want to start with this, JC. You can come right back. I mean, congratulations on winning the AFC Championship in September and the Super Bowl in September. How you like that, JC? Oh man, I jumped out.
Come on.
Yeah,
Come on, the Hurricanes and the Dolphins, both undefeated going into October.
There you go, baby. Yeah, I know. You're looking good. I had to do a little jab there, but Dolphins do look pretty good. We're going to talk a little bit about seasonality and things. So, guys, excited to be here. Like JC said, I think JC and I first hung out in the summer of 2012. I was at a research shop. I was in Cincinnati. In New York City, visiting from Cincinnati, doing some media stuff. And he's like, you're in my town, man. Let's hang out. Like, who is this guy? And sure enough, now we all know who he is. So I'm just excited to be here. Sonu is going to talk in a little bit. Sonu's amazing also. So I'm just going to get going with some of the stuff we like. I know baseball fans. JC's a baseball fan. I'm going to use a lot of numbers and things. I always love this one. Baseball's 90% mental. The other half is physical, as we all know. So it worked again. And believe me, I've been listening all morning. I did miss Frank. So Frank, I'm sorry I missed Frank. Had something going on, but I've listened to a lot of people.
He was great.
Seasonality talk. So I do have some seasonality talk as well. But I'll tell you, it worked again. This is a chart we've shared a ton over the past year and a half. And it's the presidential cycle, everybody. And you look at it, well, what tends to happen in a midterm year? You tend to have rough stock gains, right? Things aren't so great. You tend to have an October low. 6 of the last 17 bear markets ended when? In October. When you don't have a recession, you tend to have about a 24% bear market. We had a 25% bear market last October. All these things lined up. And I thought it was amazing when you look at all the strategists you see on TV. And I don't know why. I just accepted a 5 a.m. CNBC. So for some reason, someone's awake at 5 a.m. tomorrow. I'll be on TV. Hopefully I'm awake. But nonetheless, everybody told us how bad the first half of the year was going to be. And they just ignored this. The first half of pre-election years are strong. And then where are we now? That's what's happened, right? And the third quarter where we are right now, and I know, Mr. Almanac Trader himself talked about some of this stuff. It's normal to have this. I'm a huge fan of Ari, obviously. The stuff he was talking about, just the fact that you tend to have weakness now, it's not abnormal. We think this cycle is still alive and well. We think potentially new highs are still even possible this year. So we knew also coming in the presidential cycle. And this is, again, year 3. We talked about this already, with Mr. Hirsch there. But year 3 tend to be strong. And when you see there a new president in year 3, stocks do even better, right? So these are some of those things we knew about this year coming in. We didn't see a recession. I know this is a chart, so I'm not going to talk too much about the economy. Sonu's got some cool things later about breaking some myths. But the truth, again, is we didn't see a recession. We saw a stronger economy than people gave credit. That's played out. We've had a good rally. We're fully aware there are some pockets of weakness. A lot of great technicians have talked about that. But just knowing coming into this year, the idea we could have a upside surprise is what history would say. It'd be abnormal not to have strength so far this year. It's a funny little cartoon. I don't necessarily think I'm going to, well, maybe I could read it. You guys can read it there as I talk. The idea is history repeats. Okay, so go ahead and read the cartoon there. But that cartoon was from the early 80s. Okay. You literally could read that and you could say that sounds like last year. That sounds like this year. That sounds like recently, right? These cycles repeat, right? History doesn't repeat itself, but it often rhymes. Mark Twain said it 1,000 times. Love that quote. Love looking where we were. And, all the tweets I do, and I know a lot of you follow me on Twitter, so thanks. I mean, I've been get hit a lot by people lately, like in the last 2 days, like, oh, past performance is not predictive of future performance. That's true, right? I mean, if you had future data and you want to share it with me, let me know. But we have the past is all we've got. And then you read something like this, it's like, wow, that's kind of funny because history does repeat itself. And here's a cool one. Which one do I have first? Pre-election years. Pre-election years. What do they normally do? They look like this. You tend to get here. What amazes me, JC, and everybody listening, remember all those bears that were so mad at everybody the first half of the year? Stocks were going up. They were just angry. And then we saw some of them literally at the end of July, July 28th, 29th. They threw up the white flag. They said, okay, we're sorry. Now we're going to raise our targets. Now is like 2019. One of the permanent bears, you can look up which one it was, said that. They were like throwing up the white towel. And we were like, in our shop at Carson Group, by the way, Carson Group is a $31 trillion. I think it would crack $31 trillion. About $31 trillion RIA. We service 47,000 families around the country. It's a blast. I've been there over a year now. So again, I'm not a pure trader. I'm not a pure technician. I'm a macro strategist, but playing technician for this conversation. I love looking at history and stats and things like that. They're trying to mold to help our advisors see the world, their clients see the world. And then Sonu actually manages money, and he'll get up real soon and talk. You'll see how smart he is. So it's normal. This is normal. This is a pre-election. You tend to get this choppiness. I mean, Mr. Wald did an amazing job talking about this. I was like, oh, sounds like what I'm going to say. Hear what Ari had to say about things. But you have this seasonal weakness in the pre-election year. That's normal. Here, when you're up a lot, right? And what I'm saying is 10% the first half of the year. When you're up at least 10% the first half of the year, what does that year usually look like? It was stuff we were sharing for a couple months now, saying, hey, you tend to get a peak, I guess when is that exactly? Sometime in August, you tend to get that kind of sideways consolidation. And as well as history and the seasonals have played out, and believe me, we look at a lot of other things, but I'm not ignoring, and a lot of other really smart people this morning haven't either. The seasonals have worked so far like to a T almost. So we're not going to ignore the fact that they still suggest probably a pretty strong rally before this year is said and done, and potentially even newer highs before this year is done. And we think that's possible when we look at things like the way these charts have consolidated. I don't know. It's kind of amazing to me. The worst 10 days of the year are like right now. I've shared this chart. People like this chart. My son's birthday is October 19th. Talk like a pirate day. That's not a very good day to buy, but I think the worst day to buy if you hold 2 weeks was the 16th. Good news, 16th this year was on a Saturday. You get the picture, though. For whatever reason, seasonal, some bad news, the Jewish holiday, all these things line up around now. And we have clearly had a very pretty vicious sell-off relative to what we've seen so far this year by a lot of different measures. But again, it's normal. Now, the good news, my birthday is October 28th. Take a look at that. That tends to be a pretty bullish day. So there are some better times coming ahead. And again, this is what happens 10 days after you buy just any one random day at the close of the day. But again, you see a lot of green coming up. So it's not abnormal, I don't think, to see this weakness the second half of September. A couple of big picture things. This is kind of what people like about me, I guess. I don't know what they like about me, but some of these stats I throw out there maybe is what I should say. We just had a 5-month win streak. I mean, we just had a 5-month win streak. That's pretty darn rare. Now, yes, some of those months weren't up by a lot. Yes, some of those months literally happened like the last day or two of the month. I get it. But when you stack it up, you see on the screen here, when you have 5-month winning streaks, let me just take a quick look. A year later, you're higher over 92% of the time, up 12.5% on average, right? But now we're down the past 2 months, unless we have a massive rally here in September. Probably not going to happen. But again, just think about the idea that we, in all likelihood, will be higher 1 year after the end of July. We've had this weakness. We get it. And you can see 1 month, 3 months later, there's some red in there. It's kind of normal after a 5 or 6 month win streak to have a pullback. Markets don't always go up. So this is these big picture things I like to kind of have in the back of my head when we talk about where we are right now. Went a long time without making a 52-week high. Made a 52-week high on, was it June 12th, earlier this summer, right? And we went almost 18 months without a 52-week high. We all remember that because we just went through that vicious bear market. But again, what does it mean? What tends to happen next? You see it here a year later, higher every single time. I think it's 12 times. I'm not 100% sure, but whatever it is, higher a year later every time. This year could be different. This time could be different. But again, when you layer this on top of some of the other things that we look at, it just continues to suggest to us to be overweight equities. And by the way, Carson Group was one of the, I think, only places, or very few places, there was overweight equities coming into this year. People hated us. Literally, the second line of our outlook that we released start of the year said we could hit new highs this year. I had people asking me, that has to be a joke, send me your real outlook. I mean, that's what people were saying. And we laid out why we thought, all that negative sentiment, everybody thinking one way, somebody isn't thinking. General Patton used that one a lot. All the negativity, and it's not like this year's been that great from the economic point of view, but it's been better than everybody said it's going to be. And that's one reason we had this big rally. Also, everybody was bearish. I remember June of 2012 when I was running around New York, hanging out with JC. We had about like a 9.8% correction, if I believe, around then. Everyone was bearish because of fiscal cliff. Fiscal cliff was coming. And then those, remember the history books, second half was 12 was great, 13 was amazing, 14 was solid, 15 flat. But anyway, you get the picture. These things sometimes are priced in if everybody's talking about it. But again, not a bad thing when you go a while without a 52-week high going into the future. Now this one's getting a little geeky, but it's Chart Summit. So let's do this. I think a lot of you will understand what I'm about to say. MACD histograms. We just had the MACD histogram, it was bearish for more than 6 months. I think it was actually exactly 6, but the study I did looked at when it's negative, when it's bearish for more than 6 months, and then pops positive. All right? That's what we've seen all now in that MACD histogram. But when the MACD the whole time stays above the zero line, remember like in the vicious bear markets we've seen, financial crisis, tech bubble, MACD went beneath the zero line. It did not this time. Well, that's kind of interesting. So we had this flip, this new strength, but not major deterioration. What does that mean? You see it here on your screen. It's only happened a handful of times going back to 1950, and it tends to be bullish. Now, again, this MACD flip bullish at the end of July, so early August. Yes, the sell-off the last 2 months. But again, big picture telling you, something's going on here. Something's happening. Let's not ignore the message of the market that tends to be strong. Marty Zweig, obviously, we're all big fans of him. Don't fight the Fed, as JC has mentioned many times, he's known for, but it's like the 6th or 5th thing that he has in this list of things to know. Trends are what's important, but one of his things is all about breadth, right? And we saw the Zweig thrust earlier this year. When was that exactly? April or so, first quarter. Kind of complicated thing, how many stocks going up versus down, but I pumped out the numbers, and we shared this. And again, 1 year later, it's higher 14 out of 14 times. So this would suggest, we should be above where we were in April by next April, and maybe even a good deal higher when you see that blast of strength that we saw earlier this year. A couple more from me, then I want to bring Sonu in. Better times nearly here, just simple chart, right? Look at it and look at seasonality. I mean, a lot of smart people have talked about seasonality, and it's not something we just blindly invest in when you layer things on top of it, but it is what it is. These next couple months aren't all that bad, right? And think about that. And October tends to be pretty solid. I mean, let's think back for a second. Last October, right? October 12th was the closing low. October 13th, that CPI print, the F word, fundamentals came in. Had that massive 2% drop pre-market as inflation was soaring. It really felt kind of like the end of the world. We're already in a bear market. Now we're getting crushed again. What happened October 13th? Reversal. Closed up over 2% for the day, 5% off the lows. I took a look. When you go up 5% off the lows, close higher off 5% off the lows, and made a 52-week low in the midst of it, take a wild guess. Numbers are wildly bullish a year later. Talked about that literally that day with people, and you can go find the tweet. People hated it. They were saying, oh, you're a fool for even pointing this out. That's that sentiment we like to talk about. But again, the October lows are, we think, very likely. And we came into this year, I was talking about it a second ago. We came into this year overweight equities. I mean, we manage real money. We do research, yes, but we're managing real money. So it's not, so you say I'm bullish, then you can be bullish for the right reasons, bullish for the wrong reasons. You can be right for the right reasons, wrong for the wrong reasons. It's not easy to manage money and, do big market calls, but it's what we do. And again, when we look at things like this, we came into this year overweight equities. We added a little bit equity risk at the end of March. We add a little bit equity risk just on that recent pullback in August. We're actually talking about adding a little bit more equity risk right now, sometime soon over the next couple of weeks or so. Again, because we've been overweight equities, we still think this bull market's alive and well. And we've obviously done pretty well. We've been underweight bonds all year. We're still underweight bonds. Talking a little bit, maybe adding some duration. Not ready to do it yet. But those are some things we're kicking around. Just some things to be aware of. It is what it is. Fourth quarter is usually pretty darn strong. You've all seen these charts before, up about 80% of the time in the fourth quarter, 4.2% on average. That's double your next best quarter, which is the first quarter, which is up about half that. So again, we're entering that seasonal time frame that we shouldn't ignore it. A couple more from me, then bring in Sonu. Why a fourth quarter rally is likely. Just put a blog together on this, actually, and it should be live tomorrow. We are likely going to be down more than 1% in September. We know that. We were down more than 1% in August. Check out that when that happens. When you have that scenario of the seasonal weakness back-to-back, August and September. This isn't even considering what you're doing for the year. It's just simply you've had seasonal weakness. What happens next? You see it there. October's had some really amazing bounces. First off, up almost 11%, 8%, 8% the last 3 times we saw big drops in August and September. But the fourth quarter, look at that, 7% average return. So just something to think about. This seasonal weakness could be setting the ball up for a potential, in our opinion, would be surprise rally, because I don't feel like too many people are a lot of people on this call have been expecting a rally. We're not so sure too many people are talking about it, though. Another one, when you're up between 10 and 20% going into the fourth quarter, and I'm fully aware if we sell off a little more, we might not be up 10%. So we'll see where we finish here. But when you're in that kind of that sweet spot, and yes, I'll admit, this doesn't count 87. Doesn't count 87 because you're up more than 20% going into the fourth quarter. We all remember 87, the 87 crash, but that was an awfully stretched rubber band. What I'm looking for is more of the sweet spot up 10 to 20%. It's happened a handful of times. You see it there. Again, October does okay, but that fourth quarter, what is it? Up over 5.1% on average, better than your average return in the fourth quarter, and higher 84% of the times. Just a bunch of things to stack on each other. But JC, let's not forget this one. I think one of the main reasons is the Eagles lost, right? When you look historically at Philadelphia teams, when they win a world championship, bad things happen. Panics, recessions, crash 29, recession, depression, double dip recession, financial crisis, and stock's worst year since 2008. Of course, it's a joke. Sorry to all my friends in Philadelphia, but nonetheless, hey, I'll take it. As a Bengals fan, believe me, you can make fun of us because we can't make it either. So if you want to follow us real fast, I'm wearing my Facts versus Feelings shirt. That's the weekly podcast that Sonu and I do every single week. We're at carsongroup.com. We've got a blog. And this is a live picture of Janet Yellen. This is when she announced that she thought, the world was not about to end. She was reading our Outlook. That's a joke. We photoshopped it, but it looks pretty real. I actually had someone in the media say, "Is that a real photo? We want to share." I said, "No. We've got some pretty good marketing people. It is Photoshop." Nonetheless, Facts versus Feelings, these shirts, it's a pretty fun podcast. If you like the stuff that we do, check that out. Just a couple more big picture things and turn it to Sonu here. Average isn't so average. A lot of people on this know it. A lot of people might be shorter term traders, and this doesn't pertain to you at all. But at the same time, the average year is up about 9%. We know that, right? That's what history tells us. Only 1, 2, 3, 4 years, going back over 70 years since 1950, have we had an average return, which is between 8 and 10%. So average isn't so average. The other crazy one to me, 21 times the stock market's been down on the year. 20 times, again, this is back to 1950, 20 times the S&P, by market I mean S&P gained 20%. So who knows? I think we could probably gain 20% with a rally the rest of this year. That would mean you're just as likely to have a 20% gain as you are a down year. I do this for a living. That's always kind of surprises me, but I think it's really important for bigger picture things just to kind of be aware of. Average isn't so average. Volatility, also the toll that we pay, is this thing we say around Carson Group. It is what it is. Every year you see about a 10% correction on average, but you see, a 3% dip 7 times. You see the numbers. Every 3 years or so, you're going to have a bear market or so. Now, believe me, some years have more, some years have less. Those are the averages, but it's just important to kind of put that all together. The last chart from me, or this is a table, I guess. We hear a lot about the government shutdown. They're saying the government shutdown is happening. It's going to happen. We agree there. But they're saying the market is selling off due to the government shutdown. Listen, I'm not so sure about that. I think it's more we just had literally the best first 6 months ever for the NASDAQ, best first 7 months for the S&P since 97. Just some seasonal weakness, this adding to some of the concern. But here, check it out. It is what it is. Stocks do just fine when the government shut down. The last time the government shut down, stocks gained over 10% during that time. Yes, the Fed did a pivot in late 2018, as a lot of us might remember, that sparked that. But the key concept being they're going to talk about the government shutdown. There's some negatives. A lot of people are going to get checks. That's not good. We might not get economic data. That's not good. Parks are going to be closed down. A lot of things. You could be losing a little bit of GDP every single week, every shutdown of the shutdown. Good news, that tends to come back pretty quickly when people get their checks. But still, you're going to hear all about that on TV coming up really soon. I'm not so sure. We're not so sure it's really that much to the stock market, because the stock market is forward-looking and it knows that we're going to open up the government one of these days. Is kind of the way to put it, probably sooner than later. All right, so I'm going to turn it over to Sonu Varghese. He's the smartest guy in the room. I really enjoy working with him. Again, he's an engineer from Purdue. So any Big Ten fans? Sonu, I don't even know how much time we have. I talked fast, but I know take it away for a few minutes.
How many charts did he cover with that? No,
I'm going to breathe now. I'm not sure. I don't know. Yeah.
No, thank you to JC and Spencer for having me, and thank you, Ryan. This is awesome. And I did, I'm not a CFA. I'm not, I don't have a CMT either. I'm not an economist, for good or worse, right? And so I like the title. I like the fact that you call me an engineer. I like data. I like charts, right?
Yep.
I am wearing my Fred t-shirt here.
There you go.
So, but yeah, look, credit markets are not panicking, right? You think about credit investors, the credit market's massive, larger than the stock market, and they're not, triple B spreads are not showing any signs of panic. This chart actually shows high yield option adjusted spreads. It's more or less where it was back in July and less than where, below where it was last year, right? And Ryan, you talked about fiscal cliff from a decade ago. There's always some fiscal cliff or something, right? There's government shutdown, student loans, right? I think I should have a chart on student loans on the next slide. Just put a blog on this. A lot of concerns about what happens to consumption and the economy when student loan payments restart in October. In fact, interest actually already started accruing in September. But here's the thing, right? Payments have already surged. If you look at Department of Education receipts, there's a chart on the left. Over the last 30 days, right, payments have come in at more than $9 billion. That's higher than any rolling 30-day period before the pandemic. Just looking back at this year, over the first six months, January to June, payments average about $1.2 billion a month. Then in July, payments jumped to double that, right? So about $2 billion a month. Then in August, it absolutely exploded higher to about $6.5 billion. Right now, over the first 3 weeks of September, payments are about $5.6 billion. But here's the important thing, right? Consumption, right? Look at the chart on the right. That's retail sales, food services, bar spending, all of that. Consumption didn't collapse in July and August, right? When student loan payments were surging. Retail sales, food services were up 0.5%, 0.6% in July and August. That's an annualized pace of more than 6% over the last 2 months, right? July, August. And retail sales are now 17% above the pre-pandemic trend. This is not what you'd expect. The student loan payments are going to be a big hit to consumption, right? If several more reasons why student loans shouldn't be a big hit, put that in the blog for today. There's a 12-month on-ramp for borrowers, so they don't have to start paying immediately. There are a whole bunch of new income-driven repayment plans that's very generous, so borrowers are not going to have to make the same level of payments they did before the pandemic. So it's going to cut payments in about half for about 20 million borrowers. That's huge, right? So that's why we don't think the student loan payment restart is going to impact consumption or the economy too much. I mean, it's not going to be a big deal. And then, coming to the economy itself, look, as Ryan said, everyone's been predicting a recession for more than a year now. Ryan and I, we were at the opposite camp since last year. Put that in the outlook. That's why we were overweight equities going into this year. We're still overweight equities. We've been adding to equities, as Ryan said, during these different pullbacks, right? March and even August, and we're looking at the markets pretty carefully as we speak. So here's something that's less appreciated about this economy, right? On the next slide, you'll see it's a pretty different economy than what we've seen over the last 30 years. If you look at average hourly earnings growth for non-managers, right? So non-managers make up about 80% of the workforce, adjust average hourly earnings for inflation, and it's still rising above the pre-pandemic trend. Whereas if you look at real income growth for managers, it's been falling since the pandemic, right? So just since, February 2020, prices, headline inflation, right? PCE inflation is up about 15%. Average hourly earnings for non-managers is up 21%. For managers, average hourly earnings up just 11%, right? So in real terms, they've actually seen incomes fall. So the labor market, in a sense, is working better for lower wage employees. And these are households who tend to spend relatively more of their incomes, right? So I think that's one big reason why the economy, has more or less surprised everyone and stayed resilient. And you see this even if you look at how net worth has increased for different wealth groups. So the 2010s was a period of balance sheet repair for most households. Home prices crashed, stocks crashed as well during the GFC. But lower wealth groups, right, if you take the bottom 50% by wealth, they tend to hold more real estate. And so that their balance sheets didn't get back to where it was for a decade, right? We're in a very different place right now. Over the last 3.5 years, the bottom 50% has seen relatively larger gains in net worth. And their net worth has gone up 74% over the last 3.5 years. That's higher than every other wealth group, right? And it's more than what this group gained over the 15 years from 92 to 2006. Forget the last decade. Even those, in the late 90s through the early 2000s, when, wealth was increasing more or less across the board, this group didn't see as much of an increase as we did over the last 3.5 years. So just a couple of examples how this economy is different from the one we experienced over the last decade, or even before that, right? Then you talk about the supply side, manufacturing, right? Ryan, if you go to the next slide. Look, we've been seeing horrible PMI numbers for a while. PMIs, Ryan and I had a great conversation with Neil Dutta from RenMac. I mean, look, that's a survey of just 300 purchasing managers, right? You look at the hard data, the picture is very different. Manufacturing production's up about 2% this year, despite sub 50 PMIs, right? Then if you look at manufacturing factory construction, that's exploding higher, right? This looks like a chart of, some tech stock or something like that. Private manufacturing construction on the left, top panel. Private manufacturing construction of factories, that's up 67% year over year. That's after adjusting for inflation. Most of that is in high-tech manufacturing facilities. That's up 164% year over year, again, after adjusting for inflation, right? And you can see that inflection point last year, that's coming because the government's pushing a lot of money out in the form of grants, loans, subsidies. You had the Bipartisan Infrastructure Act, CHIPS Act, IRA, all of that. By the way, there's more to come. Only about 20% of the money has been allocated and doled out yet. Right? So expect more of this money to flow into the economy over the next year, right? Even if you look at manufacturing of high-tech equipment on the right, that's surging as well, right? It's up 10% year over year. That's more than 2 times the pace we saw before the pandemic. So again, don't count out the supply side manufacturing. We may be seeing some early cycle activity there, right?
Yeah, I'll just jump in for a second. So what we're trying to do is just break some narratives, break some myths, right? Student loans are bad. The economy's going to go under. No, people are still spending. You got the next one here. The lower income is not keeping up. No, lower income is, fortunately, net wealth is soaring relative to everybody else. So we've got manufacturing is just dead because the surveys tell us it's dead. No, the hard data is saying a wildly different story. What we're trying to point out here from a macro point of view, this is saying there's no recession. This is saying this bull market's still alive and well is kind of how we're going to put a bow on this. Sonu, go ahead.
Exactly. Thank you for that break. On the next slide, like LEIs, right? It all comes together in LEIs, Leading Economic Index, right? The big one is a conference board. That's been falling for 17 straight months. For 14 months, it's been saying, oh, a recession's coming, or recession's coming within 1 or 2 or 3 months, right? Now, we have our own proprietary leading index that we populate for 30 different countries. We roll it up for different regions and baskets like EM, DM, all of that, and one for the world as well. So you have a sense of what's the world economy doing, right? So a big reason why we didn't call for a recession last year, even this year, is that our own proprietary index for the US has not been pointing to a recession. In fact, right now, our LEI is saying the economy is growing above trend. In fact, it's been saying that for a few months now, right? The big difference between our version, I could spend a long time talking about this, but the big difference between ours and the conference board version is that we have a lot more consumer-related indicators, auto sales, hours worked, personal income, hourly earnings. We do have things like PMIs as well, but it's not as important as the consumption stuff, right? But the conference board's LEI is more geared to the manufacturing cycle. That's worked in the past, but obviously it's been really off this year. Finally, last slide from me. Look at returns, right? Return drivers, right? You break down returns on the right to EPS and valuations. That's the chart on the right. But on the left, you see 12-month forward EPS that's been rising for a while now. It's really jumped higher during the last 2 earnings seasons, April and July. Shouldn't be too surprising since nominal GDP is growing about 5 to 6%. Now, on the right, as I said, that's the S&P 500's return from January 3rd, 2022, from the last high through last Friday, right? And broken down by forward EPS and forward multiples. You can see how valuations have been the real drag and not earnings, right? Earnings growth did ease a little bit last year, but it's been picking up since February. Forward PEs have come down from about 22 to 18 times. The S&P is down 10% from its Jan 3rd, 2022 high. Of that, EPS growth has contributed positive 7%, right? Means nominal GDP growth has been positive, that's why. But multiples have been the real drag. Multiples are dragged by about 17%, and then you get the negative 10% for the index. So with that, Ryan, throw it back to you.
All right, I'll stop sharing.
Yes.
All right. Well, there we go. Yeah. So that was fun. Hopefully, we did a little more macro. I know this is Chart Summit, but we wanted to get a little different view for people. We've had so many great technicians already give their opinion. So that's kind of how we see the world, guys.
Should have called this segment MythBusters.
Yeah, I was thinking that. I love busting myths. Exactly.
Wait,
Detrick has been known to bust a myth or two in his day, right?
And a move. And a move.
Pride in using data to prove unfactual statements to be just that. Right?
Yeah.
All right, Sonu, Ryan, thanks a lot, guys.
Thank you, guys.
Thank you.
Ryan
been
Dietrich,
awesome. I love listening to it.
most charts of any presentation so far, right? Am I right? Does Ryan Dietrich get the most charts award?
I wasn't counting. It was a lot.
Of charts.
He ripped through them. But yeah, a lot of charts today. And don't worry, we will be sending these out to everyone.